Okay, so once again, this is Jeff Brimhall with Blue Barn Wealth, and we welcome you all to this call on investor psychology and the impact of elections on financial markets. We appreciate our partner, TownSquare, who is also on the call, and we're excited for the content that will be shared with you. This election cycle has been pretty exciting with a lot of things going on, and we're excited to hear how that might affect our accounts. The election may have effects on lots of other things throughout our lives, but today we're going to focus on how it affects financial markets and how it affects the level of assets in our retirement accounts and our investment accounts and so forth. We are honored to have Kurt Brown on the call with us today. He's the Chief Investment Officer for TownSquare Capital, and has a long list of things that he's done in the industry. He started out working on Wall Street and has owned and operated a few different firms, and now is creating TownSquare, which is one of the fastest growing RIA firms here in Utah. And we're honored to work with them and have them on the call today. Kurt's going to share with us the information about the election, all the data that he's gathered on how elections affect markets depending on which party wins and so forth. So we're excited to hear his presentation. After Kurt speaks, then we'll hear from Benjamin Cummings, a partner at Blue Barn Wealth and the director of the master's program at Utah Valley University in personal financial planning. He'll be speaking to us about behavioral finance and the ways that we think and the different biases we have just as being humans, and how we can overcome some of those as they relate to the election and uncertainty and those things. So Benjamin will speak to us following Kurt. And then at the end, we'll have a chance to answer some questions. So Kurt will stay on with Benjamin and myself in order to answer any questions that might come in. You'll see that there's a chat bar for the call. If you have any questions, you can type those into the chat bar, and then we'll monitor those throughout the call and come back at the end to answer those questions. So with that, I'm going to turn it over to Kurt, and he's going to jump right into his presentation about how elections impact financial markets. Go ahead, Kurt.
That's great, Jeff. I appreciate it. Good to be here with you guys as always. Let me do a little technology test here. Jeff, you see my screen okay there?
Yep, looks great.
Great, thanks. Hey, hope everybody's doing good. I know it's been, man, I mean, what can you say about 2020? What a year. I've been in the capital markets business almost 30 years. I was on the trading floor in New York for some of the nastiest stuff, you know, when Lehman Brothers collapsed and during the dot-com crisis in 2001 and 2. But man, this has got to go down as one of the weirdest overall years. I just, you know, and now, you know, with an election built into the middle of this and all the tensions around the election and which is normal, but it seems like every election cycle, the tension gets a lot higher. So I want to just take a few minutes and kind of share some thoughts and some things. You know, my wife has been a television reporter for about 20 years. And, you know, one of the things you quickly learn about the news business is that it's not really about the news. It's really about eyeballs. You know, it's about getting you to stop and listen, you know, and so financial journalism is no different. And so it's hard to get just unfiltered real data and information about what's going on and have it you know, not be colored with some kind of bias or agenda. So we try to do these calls to just arm you with information, and so that you can, you know, make decisions with just the right data, you know, and so we want to provide a little bit of historical context around elections and also kind of talk about some of the reality of what's happening, you know, maybe if the Democrats are elected or there's a blue sweep, or, you know, if Trump stays in office. So I want to kind of run through a few things with you, and hopefully you find this helpful. Jeff mentioned the question and answer button there that's on your control panel. Feel free to fire over any questions. We'll try to get to those. And then also we'll distribute these slides, so you don't have to worry about copying everything down. If you see something interesting, we'll email those out and you'll have access to these. You know, if you feel a lot of tension, you're not alone. The election itself is actually, interestingly, the most expensive single event to hedge stock portfolios in the history of the Chicago Board of Options Exchange. So in 40 years, this is the most expensive event to buy insurance. So you may know that when you talk about derivatives or futures or options, what you're really talking about is insurance. And you can insure against moves in financial markets, but it's not cheap. And this event in and of itself is actually one of the most expensive to ever hedge. So if you look at the delta, the overnight change in implied volatilities, really even all the way through the inauguration, right? So even the biggest commercial investors, institutional investors, we call them, they are actually also feeling a lot of tension and anxiety around possible outcomes. And so, again, it's normal, but this is actually even extra tense kind of heading into this. And so, kind of another way to look at this is that it's very rare. What you're looking at on the chart here is a 20-year chart. In orange, this is the S&P 500. The blue line is a measure of how investors feel about a potential stock market crash. And it's kind of rare to have high readings of people thinking that there's a high probability of a market crash. It doesn't really happen that often. When it happens, it usually is happening after the horses are out of the barn. It's usually like you notice this big spike in late 08, early 09. What's interesting about that is that all of the damage from the financial crisis was in the rearview mirror, but tension stayed elevated for several years, even though the market was going higher. What's interesting here is that the S&P 500 is near all-time highs or making new all-time highs, and yet the anxiety around a crash is one of the highest it's ever been. That's the bizarro world. That is not normal to have a market acting so good and yet have people feel such anxiety around a potential crash. And by the way, historically, when people are looking for a crash, you are not going to get one. Almost always stock market crashes are coming out of nowhere, whether it's like a COVID or, somebody flew a plane into a building in New York or something like that. It's usually the things we don't see coming that really disrupt financial markets. Another thing that's interesting, I studied economic history in college, and I've spent my career kind of looking around at data about what influences markets. And one of those things everybody's always trying to find, is there a correlation between political parties in DC and the stock market? And there's just not. I mean, the truth of the matter is there's no correlation whatsoever. And we can argue all day about, is one political party better for the economy or not? The problem is that economic policies and laws, some of them impact the economy immediately, like in the first quarter they're enacted, and other policies don't affect the economy for 5 to 10 years. And so it's really hard to draw lines, direct lines between how markets act and politicians, right? And so what you're looking at there is every combination of control between Republicans and Democrats and the White House and Congress going back to the Great Depression. Ironically, the worst has been Republican, right? So, I mean, you think that the political party that's really pro-business would probably have better outcomes. Again, there's no takeaway there. And that's really the point is it's very difficult to draw any of those types of conclusions. But this is why. The reason is that because over time, regardless of who's in Washington, the economy grows, and it grows in fits and starts. And so over time, you have an upward trending economy. And as a result, you have an upward trending stock market. I have another chart that's not in this presentation, but since 1960, okay, so 50 or 60 years of US economic history, the growth in earnings of the biggest companies in our country, the S&P 500, is almost identical to 100% to the return of their stocks in the S&P 500. So stocks really do in time almost directly and exactly reflect the growth of earnings. In the short term, of course, that's not true. Animal spirits kind of reign in the short term, but over time, investments are really, your returns are going to be reflected in the earnings growth of companies. And companies grow under any type of political, administration. And again, we can make a lot of good arguments about, oh, does it grow faster? And, how do tax rates play into it and things like that. But really, the point is you can't build an investment portfolio around politicians. You just don't want to. That's not ultimately what's going to drive returns to you. Okay, so let's say we get a change. We know what we're dealing with the current administration. But let's go all the way to the extreme and say the Democrats are going to control the White House and both houses. Okay, what does that look like? All right, so right now, what's on the table in terms of corporate taxes is that 28% plan that's been proposed by Biden. Okay, if you overlay his plan exactly as he says he'd like to have it, it reduces the earnings of S&P 500 companies by almost 13%. Okay, that's not quite as much as the pop that these same companies received in 2016, which was an increase of about 15 or 16%. So we're kind of unwinding a lot of the juice that was given by the Republican administration back a few years ago. Now, most consultants in this area don't think there's any way this actually happens, though. That getting that passed is going to be quite difficult. Now, they may be wrong. It may be enacted, but it's more likely that you've got something, in that 21 to 23 or 24% range when it's enacted next year, assuming that the Democrats are in control, right? And if that's the case, you're probably talking about something more in this neighborhood, more like the 48% neighborhood in terms of a reduction to earnings. So that's the numbers. That's how the numbers look for corporate America. This is ultimately what S&P 500 companies are going to be talking about next year. That's kind of the sneak preview. So if this does happen, earnings are going to be a little bit lower, but that's where they come in at. So that's the actual numbers. Now, what about the larger picture of the U.S. economy? So Washington typically controls three different levers of what's going to kind of affect our GDP. And it's trade, and then it's domestic, and then it's tax, right? These are sort of the three buckets that they can control. So we know that if the Democrats are in control, we're going to lose on tax, right? Tax is going to be a pain point in terms of GDP, right? Because taxes are going up. If for no other group, it's at least going to go up on corporations and the highest earners in this country. Okay, so to some degree, those gray bars there, if you enacted all of the proposed policies that Biden and Harris are talking about, the gray bars represent the negative influence in tax, right? So you're talking about a pretty, meaningful hit to overall earnings and GDP. Okay, but if you get the expected, what's actually probably going to be passed, it's going to be something probably a little more tame than that. Now, there's a flip side that's a silver lining a little bit in the other areas. Okay, so one of the advantages of having the Democrats win would be that trade probably ends up becoming a plus for the U.S. economy again, because we've really and again, it's not a commentary about if it's good or bad what we should be doing with our trade partners, but the Democrats have shown that they're a lot easier on trade. They're going to let the Chinese get away with certain things that the Republicans might not, or specifically Trump might not, and therefore you're probably going to get an increase in trade. By the way, that probably will ultimately help emerging market stocks that have been under a lot of pressure for several years. So you probably get a little bit, for those of you that own international and emerging markets companies, you probably get a little juice there from a Democratic administration. The other one then is the blue. The blue is really the domestic policies, and this is going to be driven largely by stimulus. And if the Democrats are in control, probably an infrastructure package that'll be quite sizable. So most people sort of agree that the next couple of years, if there is a blue sweep, that you're probably going to get a lot of stimulus. And we've already had a lot. The Republicans are probably more leaning towards trying to find ways to reduce that in the next year, where the Democrats, especially when, if they're in power and they're new, they're probably going to have the pedal down and do a lot of spending. That's probably going to be good for the stock market, whether we agree with it or not from a political or social standpoint. For the economy and for markets, that's obviously been a really good thing. That's what's kept us out of a real problem in 2020. And we'll talk more about that in a minute. So the way that we're looking at it is if there is a blue sweep, we're probably looking at what's on the right. And that black diamond is probably the net overall effect. So the negative years for a Democratic leadership are probably the out years, not the front years. The front years, there's probably so much spending and so much relief to trade, and the tax changes won't have been enacted yet. So regardless of what happens in the election, we're not really too worried about the short term in terms of the economy and the market. A lot of what's in place right now under the current administration will continue to drift into the next administration, then probably with even more spending. So if we have to handicap it, this is kind of how we're looking. Now, we know how markets are. Markets tend to price things in advance. So, it's impossible to say what the market will do in the short term, but you probably don't see an overall net major change either way. Even if the Democrats, sweep here in a couple of weeks, which of course we don't know. But we're talking about it to sort of explore what the possible next steps are here. Interestingly, and I collect every data point I can on this, the indicator of who's going to win the election that has the highest probability of being accurate for almost 100 years is this one on your screen. And oddly enough, it's the S&P 500, man. You can take all kinds of things, approval ratings and net income ratings for households and all sorts of things that are good. Nothing has been better than this one. And it's 87% accurate. And what it basically says is whatever the S&P 500 has done in terms of performance for the 90 days before the election. Okay, so this starts August 3rd, right? Whatever the market's done from 8-3 to 11-3, if the market's up, the incumbent party has won 87% of the time. That's an impressive number. So there's only been 3 cases where that has not been the case. And the market right now, since August 3rd, is up over 7%. So historically, that would bode well for Trump. But again, it's a weird year, and there's a lot going on, so you never know. What has happened in the years where the Democrats have controlled the White House and both houses? Those are all the years since 1950 that you're looking at there. The S&P 500 has actually been better on average in those years than in the overall average. Again, we talked about this earlier. The reason I show this is because I've had a lot of people reach out to me and say, isn't a Republican or a Democratic sweep really ultimately going to be bad for the economy and bad for markets? And it may be different this time, but historically that really hasn't been the case. Again, for what we talked about before in terms of correlations between political parties. So what is going to matter? We're all going to wake up on the 4th. Some of us will be happy. Some of us will not be happy. And then we're going to get back to work, right? We're all going to get back and start looking at the same information again and kind of move back on with our lives. And this is what we're really seeing under the hood of the U.S. economy. What's really in the engine right now. So a major theme that's playing out is that, there just aren't new homes. That we're at a 60-year low in terms of supply of new homes. We've seen it, in the mountain states, which are red hot. This has been a major issue. And it's a big driver. So it's not about a bubble being formed in real estate. It's just that we went through, a decade of not building enough homes. And then all of a sudden you have people wanting to leave the cities and get a house. And then you have a lot of younger generation that want to get off their parents' couch and get a house. So simultaneously, a lot of people looking for homes, and it got really hard and it got really tight. And most of you have heard that lumber prices went through the roof here this summer. And this will be worked out, these anomalies, right? There's a lot more projects now on the table to build new homes and things like that. But that's what you've seen sort of in real estate pricing. And it's really just lit a fire in terms of pretty much every real estate metric that you can measure. Here was the median home price in the bubble before we went into the 2008 financial crisis. And you can see what the median home price now is for a home in the US. So really been a big change. We've come a long ways from the financial crisis in almost every single way. And it's still fresh on a lot of our minds, but that 12 years has seen a lot of improvement in the US economy. A little weird indicator we love to watch that doesn't get a lot of attention, but can give you an indicator of how the health of sort of the U.S. economy. This is container traffic at U.S. ports, primarily the two big ports, LA and Long Beach. And you can see the inbound loaded traffic coming into those ports is just massive, making new highs. A little bit of that is pent up demand from when we made this dip. You can see that this is seasonal. So in January, it always really drops off, and then heading into the fall for Christmas season, you see a big pickup. But this right here is not the type of reading you're going to see in a recession. So we're seeing a lot of genuine demand for product really around the world. Another theme that we're seeing that's really interesting in the stock market is that companies with strong balance sheets are really being rewarded. This has not been a market or an economy that is friendly to companies that have bloated balance sheets. They use a lot of debt. They're over levered and things like that. And COVID really drove a stake, through a lot of those businesses. And so it's a theme that we think will continue to play out. We think that companies that have a lot of free cash flow, not a lot of debt, they will continue to be rewarded. And those companies will trade at higher valuations. And it's in the old days, you wanted to hide in boring. What you want now is you're hiding in businesses that are safe, right? I'll give you an example of this. What is the probability? How many people during March, during the peak of COVID in this country, thought about canceling their cell phone service? Not one, no one, literally zero, right? Well, see, it used to be that technology was a speculative growth investment. But today, technology has become our foundation of what we're doing. Who's going to stop using Google or Facebook or Visa? Who's going to stop using your Microsoft product? Who's going to stop using your laptop or your PC, right? Nobody, right? This is like one of the last things you'll give up now. And it's really led to a generational change in how we view investing in things like technology, because it used to be like investing in biotech. It was speculative. We didn't know what technologies were going to work. And now technology is really what is driving global GDP in a really major and significant way. Okay, this arguably is the most important thing that we're seeing in the economy right now. It is the amount of cash that is sitting on the sidelines, whether it's in money market funds or in checking accounts. And it's a staggering number. We go back in within the last 2 years, this has been 4 trillion. And that's actually been an increasing amount of cash from where we were historically. Okay, now we're at 8 trillion, which is an all-time record, not just in the size of the number, but as a percentage of the size of our GDP. That amount of cash has never been matched, and not even close. So Americans are stockpiling and preparing for pain. That's really the behavior. I can't tell you how many people I've talked to in the last 3 or 4 months that have said, I'm not doing anything until after the election. I am sitting on my hands. I'm holding more cash. I'm being more conservative. I'm spending less, etc. And it goes back to that thing we started with about fear. And by the way, households and individuals are not alone in this thinking, right? Here's what S&P 500 companies have done. Look at the jump in the stockpiling of cash by the biggest corporations in the world. So everybody's kind of thinking in the same boat. The reason there's a couple of reasons I'm bringing this up, and this is so important, okay, is that it's important to understand the psyche of people and their money. When you turn on the news, a lot of talking heads will talk to us about bubbles and euphoria, and the stock market's making new highs, and therefore people must be being irresponsible. That is a ridiculous narrative. The reality of what people are doing with their money is actually quite different. You don't have to look very far to learn this. Okay, the stat that I'm showing you on the screen, this is the largest aggregator of economic data in the United States, NBER. Okay, so in early September, they came out and showed us what people did with all that CARES Act money, right? And there were multiple programs created in COVID, everything from extra unemployment benefits to PPP loans and things like that. Okay, where'd that money go? They estimate that about 85% of that money went to either savings or paying down debt, which is another form of savings, right? So only about 15% of that money has even been spent in the economy yet. Okay, this is nothing like we've seen in the past. I mean, historically in the US, when stimulus is given, when there's more tax rebates, remember the cash for clunkers program in the financial crisis, people spent that money. It was like free money. And even this time around, you saw stuff on the news about, people went down and bought TVs with their stimulus checks or whatever. Okay, certainly there's some of that. But I'm showing you the data here of what people are actually doing. Look at the amount of cash that people are squirreling away. Okay, that is not euphoric, aggressive behavior with capital. And so it cracks me up when I hear people talking about speculation and bubbles and things like that. And it doesn't mean that the stock market can't go down a lot, but not for the reasons that people are talking about, right? It's just not bubble-esque. This is arguably the most important reason that the cash will impact you and I. Okay, when you look back at recessions, the same thing always happens. We get nervous, so we spend less and save more. And what happens is there's a jump in cash. Okay, so this blue line is measuring just money market accounts, right? And then what happens? Everybody finally calms down, and you can see post-financial crisis late in 2009, right? People slowly start spending that money again. Okay, so that cash explosion becomes very important because it lays the groundwork for the next bull market, the next economic expansion, if you will. So that cash comes back out into the system. So this record amount of cash that we're sitting on, it's going to come back at one level or another, right? Now, we'll talk about inflation in a second, because that always is the risk, right, of a lot of cash in the system. But for now, this is a really important driver, and in my opinion, is the number one most important thing in the system. The other thing that it's doing is all of that cash combined with really low interest rates is giving companies margin of error. Let me give you an example. Okay, let's take Google. Okay, Google came into the spring with $100 billion in cash in their bank account. Okay, an insane amount, like bigger than the GDP of most countries. Okay, then they went out and they did a $10 billion bond offering. Why on earth, if you don't know what to do with your cash, $100 billion in cash, they don't know what to do with it. Why on earth are you going to borrow $10 billion more? Well, the reason is they borrowed it for 5 years for 0.45% interest. Think about that for a second. That's free money, right? Google borrowed $10 billion for 0.45%. So anything that they can find to do with that capital that has any rate of return associated with it, maybe it's buy their own stock back, but maybe it's buy other companies, develop new initiatives, whatever it might be, they're probably going to make more than 0.45% on that investment that they make, right? So even if they turned around and bought other bonds with it, they'd pick up a couple percent of arbitrage, right? So this is what's happening in this environment. That's why the low interest rates and the liquidity is helping us so much. It's why 2020 didn't end up being a catastrophic year for us, because there's lots of liquidity in the system, right? Now, let's talk about that inflation concern, right? So the money printing, the blue line, the M2 money supply explodes, right? We saw this happen coming out of the financial crisis, right? The creation of a lot of money, but we've seen it in the other recessions as well. This is not new. It's not a new strategy by the federal government, but this printing in this short amount of time, you have to go back to World War II to find the only thing in history that matches this kind of money printing, right? But the yellow line is what actually leads to the inflation. The creation of the money doesn't lead to inflation. It's what people choose to do with the money. It's what I call the aggressiveness of money, okay? So there's this velocity is a funny way of saying how many times does a US dollar move through the system in a year? And when velocity is going up, you're creating inflation, right? It's the money itself is becoming more aggressive. It's chasing assets and it's working its way through the system faster. Look at this. We are literally at an all-time low since the data has been tracked with the velocity of US dollars. This goes right back to what we were talking about a minute ago. Where's the money going? It's literally being parked in banks and on balance sheets, and it's not going anywhere. People are not trying to buy the next speculative home or borrow money to buy another business or whatever it might be. They're not trying to necessarily buy the next motorhome in the way that they may have in the past. And so that velocity, as long as it's low, you just don't get any kind of hyperinflation. You get pockets of inflation, right? We're seeing inflation, and we've seen it in healthcare for years. We saw it in college tuition. We're seeing it now in housing, but you're not getting this macro hyperinflation that everybody's worried about, where you have to own gold in your safe at your house. I suspect we will never see that in this country. I know there's a lot of hand wringing about it. There's a lot of other factors historically that come into play when you talk about the devaluation of currencies in countries like Venezuela, Argentina, Thailand, Germany in the 40s and 30s. We don't have that backdrop. That's not who we are. On top of that, whenever there's stress in the global system, where do you want to put your money? You're not going to park your money in China. You're not going to park your money in the United Kingdom or Brazil. You put your money in the United States. We see it in every single cycle. So hyperinflation should be the last of your concerns. Now, at some point, the velocity of the money picks back up. People feel better. They relax more and want to invest and spend again. But so when you talk about the S&P 500 sitting near highs, you're looking at the data. It's not because people are chasing risk assets, right? In fact, it's almost the opposite. The mentality has been one of real discipline, both at the corporate level and the household level. A couple of the things, Jeff, that I wanted to touch on before I throw it back to you guys. There were 6 programs created that allow the Fed and the Treasury to inject capital into the U.S. economy to help us at times of stress, like COVID or the financial crisis. The orange bars are the size of the facility. This is what Congress has authorized for them to spend. And as of the end of August, the little red boxes are how much has been used in those facilities, okay? They've barely been dented, right? The facilities that the bazooka, in other words, that the Fed and the Treasury could use to put cash into our system, we haven't even scratched the surface. So when people talk about the Fed's going to run out of bullets, I don't know what bullet they're talking about. We're not even in the ballpark with that conversation. Now, there is something the Fed can't control, and that's making you and me spend. And so deflation is probably as much of a risk as inflation. And the Japanese had to deal with this for 30 years, right? How did they get their citizens to go out and relax and spend some money and quit saving everything? And that's frankly what the Fed is spending their time talking about right now. They're not talking about bubbles. They're talking about how do we get the American people to relax and not think that the markets are going to crash. So we're still in a mindset of ultra low interest rates and staving off deflation. So we just don't want anybody losing sleep over this narrative of really high interest rates and hyperinflation and things like that. We're a long ways from that. So what are we worried about? This unemployment picture, it's been stubbornly high since the peak of this corona. We got it down some, but not nearly enough. Now, why has this not hurt our economy more yet? Okay. And it's because of the yellow writing that you see there. Okay. So when we were giving everybody that was unemployed $600 extra a week, okay, that was this group in here. Okay. This was what the CARES Act covered. When we were giving everybody the $600 extra a week, what it did was it allowed for 76% of these people to make more or the same as they were making in February. So 76% income replacement to what was lost. And now even at the $300 a week, you still have half of these people are making the same or more as they were in February. So when we all wonder and look at each other and say, how's the economy not imploding with 30 million unemployed? That's how we got away with it. We paid people to stay at home. And that's the transfer. We don't allow you to come out and work, so we're going to give you money to stay at home, right? So now the unemployment numbers are softening. We're down, about 10 million have been put back to work. We got to get this has to improve a ton. And to a certain extent, it's going to improve when we get a vaccine. Certain industries are allowed to work again. People feel more comfortable going to restaurants and flying and going to hotels and things like that. But we have a certain block of people that need to be retrained and reallocated to other industries. And the good thing is there are a lot of industries in this country trying to hire. A lot of the tech and healthcare space can't find people. And so we there's going to need to be that natural transition that economy has to do from certain industries into other industries. But this right here on your screen is a big deal. And the stimulus, if we just stop it cold turkey, that's a big deal. The market is not prepared for something like that. The market is operating under the assumption that we will keep paying these people to a certain extent, not to go out and go back to work. And this is something that has to be reckoned with. I'm going to skip over a couple of these here. The only takeaway here is the blue line is bank lending standards and how tight they are. Banks have gotten very, very careful about lending money right now for obvious reasons. But interestingly, the red line is the demand for consumer loans from banks. The demand is also plummeted. Isn't that interesting? It's so crazy to go into a recession. Normally what you would have is real demand for bank loans because people want the money. People don't want debt. Nobody wants debt in this environment. And so it's really interesting to see the demand continue to drop. And it's one of the reasons that you're seeing the velocity of money so low. And again, supports our thesis about inflation not being the problem. I do want to give a couple words of warning. One of the things that's happening because of ultra low rates and really easy money is that a lot of corporations are issuing really long bonds. That's dangerous. Be careful with that. You want to understand the nature of the bonds that are in the bond funds that you own. Or if you own bonds directly, you want to know what you own. It's a lot more speculative and risky to own these really long bonds. And we see a lot more companies doing this now because they can get away with it. And there are bond fund managers that'll buy these bonds because they are desperate for yield. They're desperate for interest. The junkiest part of the bond market, that triple C space and lower, has seen a lot of new defaults this year. A lot of that comes out of energy. So be careful. We're not seeing a lot of defaults yet in the higher credit qualities, but it could come. And so you want to be absolutely certain about what you own in bonds. They're not the boring investments that you think they are. And so that's something you want to pop under the hood a little bit and have the guys take a look at for you and give you a second opinion on. This is another one of my really big concerns. You see that the explosion of these zombie companies since the financial crisis has really been staggering. These are the companies that their debt interest expenses, just the cost to pay the servicing of their debt is more than their profits. This is terrible. This is a terrible indictment. There was never zombie companies in this country because they went bankrupt. Nobody would give them money. We're in an environment now where through the junk bond market and the secondary lending market, you can find people willing to lend you money. People are desperate for interest rates, right? They want to know they can have something that pays them 5, 6, 7, 8, 9% annual interest. The problem is a lot of these companies are terrible. And so this is something we want to be really careful about. 17% of publicly traded companies now are these zombie companies. And this is really because of low interest rates and easy money. So where do we see this play out? There are certain segments of the stock market that really are struggling. A lot of parts in value, right? You've heard that value companies struggle. Well, part of that is because these companies tend to end up being value companies. They don't have any growth. They're lumbering along and trying to survive, and therefore they're not growth companies, right? So one of the reasons that the value space is really underperformed is because of the existence of these types of firms. So just like the bonds, you want to really talk to your financial advisor about, hey, what do I own? And do I own quality companies, or do I own companies that really have bloated balance sheets and a lot of debt and things like that? So just a little word of warning. So I'll close with this. This is what we have in terms of working game plan. There's probably going to be more volatility, but what I will say is I think there's just as good of a probability now that after the election kind of comes and goes with a whimper. I think we've all been so tuned up for chaos that you probably almost could have a quiet end of the year, which, man, would be such a welcome thing. I mean, I obviously could be wrong about that, but there's been a lot of anxiety. So we just like to be ready for volatility wherever we can get it from. We obviously want to have a little bit more cash because, when you have volatile environments, you kind of want to be ready, you want to be opportunistic. We really want to emphasize the owning of high quality assets. Even if something looks cheap, if it's got really weak fundamentals, man, we just don't want to own it. It maybe is cheap for a reason. Want to be careful with these zombie companies and certain types of indexing and things like that. But primarily, we want to maintain our financial plan. And when we get in times of stress and high emotion, it's really normal for us to want to do something. We want to act. But sometimes those can be the worst times to make knee-jerk reactions. And elections have historically always been one of those. Just because of the things we talked about before. And in almost every presidential election year, the next few months after the election, the market actually does quite well, because there's a little bit of relief to, oh, hey, the world's not ending, and we're kind of getting back to business here, and let's get back to work and what we're doing, And so that's it, Jeff, for my prepared comments. And I just want to wish everybody the best of luck and a great fourth quarter, and I hope everybody's doing well, and don't hesitate to reach out to us with questions about your specific investments and those kinds of things.
Thank you, Kurt. Now we're going to have Benjamin come on and share with us some about behavioral finance. Benjamin, are you there?
Okay, sorry, when I shared the screen, my mute option went away, so I apologize for that. Are you able to see the screen, Jeff?
Looks good.
Great.
Yep, we see it.
Okay, thank you. Excellent. Well, thank you, Kurt. That was a great lead in and excellent discussion of kind of where we are on things. So I thought it would be helpful if we take this backdrop of where we are in the financial markets and now tie it a little bit, if we look under the hood in our own minds, of how do we actually approach this from a psychological perspective. So that's what we want to talk about next. And I think really the backdrop for this is what I think about when we call what we call loss aversion. Now, this comes from Nobel Prize winning thinking from Daniel Kahneman and his colleagues. They built a theory called prospect theory. And it's basically this idea that as we look at financial outcomes, we need to also consider the psychological value that those outcomes are going to provide for us. And when we look at the outcomes, what we pick a point that we're going to refer to, and that from that point we may have a gain, and those gains are going to feel good. They're going to help us feel better about where we are. I mean, who doesn't like winning? Who doesn't like a gain? And when we look at our investments, we say, hey, we're up. This is fantastic. It helps us feel good. The other side, though, is that we may also have losses, and we don't like losses. Partly because, in a very literal sense, the pain part of our brain gets activated when we experience a loss. It literally hurts. So the same way that we process pain is the same way that we process financial losses. And so what you'll notice here, though, is on this chart is that what we found is that gains feel good, but losses hurt about twice as much as gains feel good. And so that's really what this idea of loss aversion gets at, is that we are averse to loss. It hurts, and not only does it hurt, but it hurts twice as much as a gain might feel good. And so in this kind of uncertain environment is we're very conscious of the possibility of a loss because of all the uncertainty. I mean, Kurt did a great job kind of highlighting on the concerns of some of that uncertainty. And so what happens is that we don't like risk. We don't like taking risks because it could lead to a loss, and that's going to hurt. And so that brings up a concept that we call ambiguity aversion, is we are averse to ambiguous circumstances. And this kind of goes a step beyond this, that not only do we not like risk, but when risks are unknown, we're very skeptical about those unknown risks, and we'd much rather have a known risk. And so we favor known risks over unknown risks. And so with that idea, in this kind of an environment, what we're trying to do often psychologically is we're trying to shift our financial situation from something that we're not sure what's going to happen, like with the elections, to something that we do know about. And so that's where we tend to look for it, is we want to say, well, hey, I don't know what's going to happen. I don't know what's going to happen with the election, but not only that, I'm not sure what's going to happen as a result of the election. And so we try and think of, well, then what can I do to try and shift to some of the known risks instead of some of the unknown risks? And so what we tend to default to is that we want control. is that we want to act. We want to say, I have to do something. I have to, change something in order to prepare for this unknown risk, or I need to shift my situation away from these unknown risks into more of a known risk. Now, here's where I'd offer some of the caveats, is that when we act, really all we're doing is that we're changing our perceived sense of control, but not really our actual sense of control. Our actual control doesn't really change all that much. Is that we are where we are. We live in this global economy where we have live in this wonderful democracy that changes power every 4 years, or at least we have an opportunity to elect new leaders every 4 years, and to a lesser extent other local and state leaders on an annual or biannual basis. So when we are trying to act in ways, it helps us feel better because we increase our sense of control, but it doesn't really actually impact the broader scheme of things as much. So then the question is, well, what can we do? What if we want to act, we want to feel better about things, what can we do? Really, I think the best thing we can do is vote. Like that is one way that we can in our democratic economy to help impact things in a productive way, is to vote. Now, if we're worried about Trump staying in office, or we're worried about Biden being elected, either way, when we make our voice known, then that is how we can act in a productive way, is that we can be empowered in our democratic society to act in this way. And that's where we can actually influence and have an actual sense, an actual control, rather than just a perceived sense of control. So if you're feeling things are a little chaotic, if you're not sure what's going to happen, like what Kurt said, is we may have some trends one way or another, but honestly, we just don't know for sure what's going to happen. The best thing we can do if we want that sense of control is to act. So then I want to shift now to a second concept, what we call anchoring. And I think a great example of anchoring is a study that was done on a college campus where they asked participants to think of the last 2 digits of their social security number. And then what they did is they asked them to bid on a variety of products. Maybe it was a textbook, maybe it was some chocolates, maybe it was a glass of champagne or a bottle of wine. And they wanted them to think of the last 2 digits of their social security number in a dollar form. And then they asked, would you be willing to, for example, pay in dollars the last 2 digits of your social security number for a box of chocolates? And then you could decide yes or no. And then their follow-up question was, well, what's the most you'd be willing to pay for a box of chocolates? And what they found was that even though the students and the participants, they understood that their social security number had no impact on the value of these products, this box of chocolates, those who had high social security numbers were willing to pay much more for the product than those who had low social security numbers. So what does that mean? Well, what it means is that by introducing the concept of a number, even though it had no relation to the cost or the value of the good, it influenced their financial decisions. And that's what we call anchoring, is that the participants, they are anchored on their social security number as a reference point for the value of deciding whether or not particular good, the box of chocolates, is worth paying for that. And so if we shift back to this idea of loss aversion, really what we have to remember is that the point at which we decide if something is a gain or a loss is we have to have a reference point. And that reference point is arbitrary. Really, we decide what that reference point is and what becomes our anchor. And so when we're trying to decide, well, are we in a gain position or are we in a loss position? It all depends on what we're picking as our anchor. Now, our anchor might be our purchase price. And so, and that's a pretty natural anchor, because whether we pay capital gains or whether we pay capital losses depends on our purchase price of a particular investment. And so that's a pretty natural anchor, but we might have other anchors. Like we might look at our portfolio value as of January 1. And we might say, hey, are we in a gain position since January 1? Yay, I feel good. I'm in this gain space. Or maybe we're down and we say, oh no, I don't feel so great because I'm in a loss position. So this is impacting then whether our anchor impacts whether we see things as a gain or a loss. But we ultimately decide what that anchor should be. Should it be our purchase price? Should it be January 1 values? Should it be, beginning of the quarter values? We get to decide what that anchor is. And so kind of the question that I have for us is, should values as of election day be our anchor? Now, a lot of the rhetoric after election day is going to use market values as that anchor. Even some of the research that Kurt was citing focuses on this idea of, well, what are returns before and after election day? That they're using the election day values as the anchor. And so they're trying to make decisions of, can we build some predictions of before or after? And are we going to be at a gain or are we going to be a loss, depending on who takes control of the Congress and who's in the White House? Kind of my argument, though, is maybe election day isn't the best anchor when we're trying to evaluate whether or not our portfolio is in a good position. And so instead, really my suggestion is, let's anchor on our goals. Let's use that be our reference point. And really that's the perspective we take at our firm, is rather than saying, hey, let's try and anticipate what changes may come, because honestly, we don't know. We don't know what the outcome is going to be, and we don't know what's going to happen after that. But we do know in the long run, we want to make sure that we're on track for our goals. And that's what we want to make sure that you're comfortable with. And so, if anybody's not feeling certain of their path on their way towards their goals, please reach out to us. We'd love to have a conversation. We'd love to talk to you about how your portfolio is designed for the long run game, where you can make sure that your game plan is on track to achieve your goals. And as long as we're on track to achieve your goals in the long run, that's what matters most. And that's where I would say we should be anchoring, is that long run game plan of making sure that you're able to accomplish things that you want to do in your life. So that's kind of our behavioral finance recap. So Jeff, thank you, and I'll pass it back to Jeff to wrap us up.
Thank you, Benjamin. Really appreciate that insight. And we're all human. We all have these biases, and as hard as we try, it's hard to overcome them. And it's nice to have them presented in a clear way and help us kind of question or rethink how we're perceiving things. So we appreciate those of you on the call today. Again, this is being recorded as well. So if you want to share it with a friend or a family member who you think this would be good information for them, then we'll make this available to you shortly after the call later today or tomorrow, so you can share that with others who weren't able to be on the call live. And we appreciate you taking the time to be on the call. Kurt, thank you for being here with us and for sharing all the data and all of your experience around financial markets and the impact of election on those. And we really appreciate the time that you dedicated to us and the clients and so forth. So thank you very much for that. So at this time, we're going to end the call, and we look forward to, if you have any questions, you want to reach out to us, please reach out to your advisor, and we'd be happy to answer those and help you in any way that we can as you prepare for the upcoming election. So thank you very much.